Let me start today's video by showing you a couple of stock charts. As you can see, the year 2022 has so far not been particularly kind to investors. The Nasdaq is down some 30% and many tech stocks are down much more, 50, 60 or even 80%. And it almost seems like the market treats many of the so-called COVID winners indiscriminately the same way, regardless of their fundamental development and fundamental outlook. Their stock chart patterns basically look like this. The stocks experienced a significant boost in their share price after the COVID pandemic bottom in March 2020, were often up 200, 300 or 400% within a few months, and then since late 2021 experienced an almost unprecedented sell-off and are down somewhere in the range of 60 to 90%. And this sell-off is largely caused by a very challenging macro environment, characterized by geopolitical tensions in Europe specifically and Russia's war of aggression against Ukraine, very high inflation rates that have led to central banks increasing interest rates, which in turn impact prices of long duration assets such as stocks and growth stocks in particular, and a dramatic surge in commodity prices. And on top of that, many businesses are experiencing slowing growth, and we're even witnessing hiring freezes at major companies such as Facebook, Wayfair or Twitter, and layoffs at companies such as Netflix or Klarna. And this brings us to the topic of today's video. Undoubtedly, growth rates have slowed, but indiscriminately treating every company the same way is certainly a mistake. But this is what the market is doing right now. The stock charts all look the same. And I think therein lays the opportunity. And I would even argue that the current environment may be the greatest opportunity set that investors have seen over the course of the last 10 years. And your job is to identify where the market is wrong about future growth rates. So what we will do is we will divide the so-called COVID winners into 4 different buckets, 4 different growth paths, and determine the growth trajectory they will likely follow in the future. And so without further ado, let's get started. When you want to find stocks that outperform over the long run, you want to find companies that can grow both revenue and profits at above average rates. This is what Mark Mahaney concluded in his book, Nothing But Net, 10 Timeless Stock Picking Lessons from one of Wall Street's top tech analysts. And in the chapter titled Revenue Matters More Than Anything, he wrote the following. Companies that can consistently generate 20% plus top line growth can potentially provide good stock returns almost regardless of their near-term profitability. Only about 2% of the S&P 500 companies have been able to consistently generate 20% plus top-line growth for 5 years. But these stocks have usually materially outperformed the market. But in a way, the COVID pandemic has created a problem for those who want to identify companies that can grow their revenue at, say, mid-teen percentage growth rates. And that's because the unique circumstances of the pandemic and the nationwide lockdowns that basically citizens all around the world experienced created both so-called COVID winners and so-called COVID losers. The COVID beneficiaries were companies with exposure to work from home, such as Zoom video communications or Slack, exposure to the entertainment industry, such as gaming stocks or streaming service providers, and businesses operating in the e-commerce space, such as Amazon, Farfetch or Etsy. So-called COVID losers, on the other hand, they had exposure to the travel or leisure space, such as theme park operators, typical sit-down restaurants or airlines. And they, of course, experienced a dramatic slowdown or even decline in their top line and profit growth rates. I would argue that the pandemic was basically a black swan event, and in a way one now has to normalize the results of both COVID winners and COVID losers, and also look at the performance of each company at an individual level. And in this video we are going to focus on the COVID winners. These companies experienced a dramatic acceleration of their growth rates, and when their growth rates shot up in 2020 and 2021, their stock prices skyrocketed. And now when their growth rates are seemingly reverting back to the trend, the market is punishing these stocks as if they will never grow at above average rates again. And that's why the stock charts of all of these companies, the charts that we have shown you at the beginning of the video, they all pretty much look the same and have the same pattern. The market is treating those stocks as if their growth rates will be much slower for a very long time. But is this really going to be the case? I would argue that it depends on the business that you are looking at. Some companies will be able to maintain their improved results, while others will likely be struggling. And in this context, as I said at the beginning of the video, I want to introduce a framework that distinguishes between 4 different paths that businesses may take, and it may help you categorize these so-called former COVID winners. I would argue that the market is clearly struggling putting these COVID winners into the correct bucket. And please let me know in the comments down below whether you agree with the examples that I chose for each bucket and which companies you might want to add to the list. And before I get to the framework, I need to give credits to Elliot Turner here, as he basically developed this framework and shared it in both a recent podcast episode of the This Week in Intelligent Investing podcast and also an investor letter from RGA Investment Advisors. I just want to make clear that I'm merely paraphrasing the insights that he, so Elliot Turner, had. Okay, so here's basically what each graph will look like. We are looking at the growth trajectory of a business that is growing steadily as it enjoys some kind of structural growth tailwind. This may be e-commerce, cybersecurity, electromobility, digital business communication solutions, or digital payments. And then COVID happened, and as people were stuck at home, some of these structural tailwinds were accelerated and experienced a significant boost. So growth rates accelerated, and the interesting question now is what happens next? And this brings us to the first path a business may take. Well, after the COVID-induced growth tailwinds, the first set of companies will experience a slowdown in growth before there will be a reversion to the pre-COVID above average trend growth. And I would argue that most e-commerce companies, for example, fall exactly into this bucket. Let me just share 2 graphs with you here, and then we will look at one specific company. So first of all, here's a graph that investor Dennis Hong shared in May 2020. So right during the first wave of lockdowns. It shows that the COVID-19 pandemic has accelerated the shift from retail to e-commerce. Basically, e-commerce penetration has risen from 16% to 27% in just 2 months since the start of the pandemic. So you could argue that this space saw 10 years worth of growth in less than 10 weeks. Now let's consider a more recent graph. This graph here was shared by Twitter user Mostly Borrowed Ideas the other day. And it's based on JP Morgan data. And as you can see, e-commerce penetration has actually slowed considerably following 2020. This is also confirmed by another data set and this graph here. And we can make this observation not only at an industry level, so the e-commerce industry level, but also by looking at the fundamental development of individual companies. Take Etsy, for example. In 2020, they grew their top line at a triple-digit rate. And fast forward to today, and when they are lapping these impressive numbers, well, growth has slowed and almost come to a halt in the most recent quarter. And it certainly remains to be seen whether Etsy can actually re-accelerate its growth to the trend growth level. Personally, I would argue that the majority of COVID winner stocks probably fall into this bucket. Other companies that possibly fit into this category could be Shopify, Wix.com, or Amazon. Next, let's focus on the second basket of companies. Here the graph looks like this. So of course, these businesses also experienced accelerated growth during the COVID pandemic. And now their growth slows as well, but to a lesser extent. Basically, their growth rates normalize, but growth goes right back to the trend growth level. And while the majority of businesses probably fall into the first bucket, I would argue that only very few companies actually belong to this second group of companies. They are quite rare and hard to find. And in the podcast episode that I mentioned earlier, the show hosts mentioned Roku as a business that may fit into this category. The business also experienced a very rapid growth during 2021, growing at rates of 60 to 70%. And now that the business is lapping these tough comps, broker still manages to grow at impressive double-digit rates. Another and third path a company may follow looks like this. Basically, growth will slow considerably and might actually turn negative before growth reaccelerates to the trend growth trajectory. So that's the difference to the first category. And a company that may serve as an example here could be gaming company Nintendo. As this chart here shows, Nintendo also posted impressive growth, even doubling its revenue in one quarter, and was growing at a healthy rate during some of the other quarters, 40 or 50% year over year. But then, when the business was basically lapping these results, growth actually turned negative during some of the most recent quarters. Now, the last group of companies are those that also experienced accelerated growth, but who then saw their growth slow down significantly and who will possibly not be able to get back to the trend growth level. Essentially, the idea is that these companies captured such a significant percentage of their total addressable market that going forward, their long-term growth rates will be much slower. Which companies will fall into this bucket is hard to say, but arguably companies with relatively small total addressable markets. You could possibly think of businesses like Peloton. The number of households that are interested in Peloton's premium connected fitness products may be much smaller than anticipated, and Peloton may already have captured a large chunk of their total addressable market during the pandemic and will now, of course, see growth in both revenue and users at significantly lower levels. Maybe Netflix, a company that also disappointed on fundamental levels recently, could also be a candidate for this group of businesses. Now I'm curious, please let me know what other companies you can think of that may fall into one of these four categories. So what is the key takeaway here? Well, as we have stated before, the market is certainly selling off all the so-called COVID winners right now. When these companies saw their growth rates accelerate, the stocks of these businesses basically exploded and valuation multiples expanded to almost never before seen levels. But now that growth slows down and arguably normalizes, these businesses and their stocks are punished. I like the way Joe Frankenfield put it. Is it possible that last year the market extrapolated 2021 growth rates far into the future and are now extrapolating 2022 growth rates far into the future? So if you can identify the businesses whose stock prices are punished, but who fundamentally will do very well over the long term, whose growth rates will reaccelerate, or who can sustain their pre-COVID growth, well, then you can take advantage of the current market environment.